Hey everyone, Kirk here again at Option Alpha, and in today's video we are going to talk about iron condor adjustments, which undoubtedly is one of the most requested topics and something that a lot of people ask about, something a lot of people still don't understand, even a lot of our Pro and Elite members, even though we've covered it a bunch of different times in a bunch of different ways, but I figured I'd do this kind of whiteboard video today here inside of Facebook. So if you're joining us, again, my name is Kirk. I'm the founder and head trader over at Option Alpha. And today's going to be talking about, again, like I said, all about iron condor adjustments, right? So as always, as we're going through here, let me know what questions you guys have. If you have questions, pop them in there so that we know what questions you guys have as we go through. I'll make sure that I try to jump in here in the comments and get some of those as much as I possibly can as we kind of cover this. But let me just kind of go through the basics of how it kind of works so you guys understand the whole thought process. And for those of you who are new to trading, just a quick recap on what an iron condor is. If you've got a stock that's trading in a range or whatever the case is, what you would do with an iron condor is you would sell a call at a higher strike price. So if the stock is trading at $50, you might sell a call option at say $55, and then you would buy a call option at a higher price, say $60, right? That's your call spread side of the trade. And down below the market, you might sell a put option at say $45, and then you would buy a put option at $40. And again, that's your put spread side of the trade, right? So all you're hoping to do is if the stock closes anywhere in this range, that's when you profit, somewhere between about 55 and 45, right? Not including any premium that you take in, right, for break evens, which we'll talk about here in a little bit. But that's the general consensus, right? So the issue with this is, what do you do if the stock that was trading at $50 now starts trading higher, right, and goes through your call spread side, or starts trading lower and goes through your put spread side, right? So what do you do? How do you end up adjusting this type of position? It's very much and very similar to how we think about adjusting strangles, because we've done other Facebook Live on that as well. But I'll kind of run through the thought process and why we do it this way with a graph so you can see. So this is a payoff diagram of what an iron condor looks like, right? So you probably have some sort of stock line here, right? And this is our profit window, right? This is where we could potentially make money. So if a stock is trading at, again, $50, we might sell the 55 calls here, buy the 60 calls here, sell the 45 puts here, and buy the 40 puts here. Okay, that's like your basic general diagram, right? So you're hoping that the stock trades somewhere in this range, and if it trades down in this range here, right, or down here, that's when you end up losing money, right? So we don't want the stock trading down there. So the whole premise behind doing a cover or a iron condor is that we want the stock to trade in between here, but we've got these break-even points that are on these like X's that I'm drawing right here. And I really wish I should get a different pen, but that way you can see them in different colors, but they are what they are, right? So that's our break-even points. Now, if the stock is starting to challenge us towards the top side of our payoff diagram, right? So it's starting to challenge our call spread side. Remember, these are calls that we traded, these 55 calls and these 60 calls. If it's starting to challenge us by moving higher, the first thing we want to do is leave the existing call spread side intact, okay? So you do not touch this side of the trade. Instead, what you're going to do is you're going to take the put spread side of the trade and you're going to roll that side higher, okay? Does that make sense? So you roll, and many people call it different things, call it moving the unchallenged side higher, the untested side higher. Whatever the case is, all you want to do is you don't want to basically dig yourself a deeper hole by moving the call spread side higher. This happened just the other day to a member who I did a coaching session on, like an emergency coaching session, because they did this where they moved the call spread side higher, right? And you move the calls higher, right? So maybe you close out of the 55s and 60s and then sell the 65s and buy the 70s, right? You just basically roll the call spread side higher. Well, what's to stop the market from continuing to move even higher against you? So you basically just dig yourself a hole and a deeper hole and a deeper hole, hoping that the market's going to turn around. But we all know that there's a lot of times where the markets just are range, they're trending and they just move in one direction for a while. So again, what you want to do is you don't want to touch this side, right? So leave that side alone. If it's going to go bad, it's going to go bad, right? You don't want to dig yourself a little bit deeper. You want to move your put spread side closer to where the calls are. So let me just redraw this here for a second, and let me know just generally if you guys have any questions about this right now. I'll jump back in here in a second, okay? So we're getting a lot of people on here, which is good. So let me just redraw this payoff diagram. And I won't draw it, to scale like I did before, right? So again, here's your kind of middle line, your profit and loss. This is making money, right? And down below, you're losing money. So if the stock moves higher, what we want to do is we want to close out of this side, right? This put spread side here, and we want to move it closer. Now, when you do that, when you roll it closer, remember, this put spread side now, because the stock is rallying away from it, is probably going to be worth less money. So conceivably, you're going to close this thing. Let's say you sold it originally. Let's say your original sell was for, I don't know, $1 of premium, so $100. And now you could close it and you could buy it back for, let's say, I don't know, 20 cents, right? Like, because remember, the market moved higher. So let me just scooch this down so you can see it. Remember, the market moved higher, so you can now close this thing for less money, right? So now you take in, technically, a paper profit here. Now, I don't count that as really a profit because it's just part of an adjustment to a trade, but you took in a paper profit of, say, $80, right? But now what you can do is you can sell something closer, and when you sell something closer, right, to where the stock is trading now, remember, our stock was trading at, say, $50. Let's say we sell the 50 strike puts and buy the 45 strike puts now, right? So now we're selling the 50 strike puts, which are right at the money, and selling the, and buying the 45s, right? So by doing this, let's say we take in an additional credit. I don't know, at this point, maybe like $1.20 now, right? We take in an even bigger credit. That additional credit just kind of helps pad your overall P&L for the trade. So if you take in an additional credit by selling that of $1.20, that moves your break-even point out on this end. And this is the key to this whole thing. It moves your break-even point out on this end by $1.20, okay? So now your break-even goes on this side of the trade. Remember, the call side you didn't touch, but because you took in $1.20 credit on rolling up your put spread, closing one and reopening the other, because you took in $1.20 credit, that $1.20 credit moves your break-even point out that much further on the call spread side. So even though you didn't adjust the call side, now you still have some extra wiggle room. Now look, it's not a lot. It might be $1.20, it might be 40 cents, might be 50 cents, but look, it's better than nothing, right? And as the market continues to go higher, that's all you do is you just continuously adjust the put spread side higher and higher and higher, right? Now, what we suggest is you generally, although we do it sometimes, you generally don't go what's called inverted. And what I mean by going inverted is that you don't want to have your put spread side be higher than your call spread. You want to generally roll and adjust until you get into this type of payoff diagram, which is an iron butterfly. And at an iron butterfly, your call and your put short strike are exactly the same. So in our case that we've been looking at, this would mean at most rolling up so that you have the 55 short puts and the 50 long puts here, right? So maybe you roll once or twice, however you get there, and you have the 55 short calls and the 60 long calls, okay? So that's what we would suggest in most cases doing. Right now, we can go inverted. We talk about going inverted. In fact, there's a couple links up above here that I'll add to the video. If we're doing a live stream, we'll add it later on so you can see it, to some of the training and free courses that we have that go through more examples of this and show case studies. So you just want to click on that link above. But we do go inverted, and there's some special circumstances that we'll cover in other live streams about like how you go inverted and the credits that you take in. But the whole idea here is that if you can, you want to just roll and adjust until you turn your iron condor into an iron butterfly, which is the same short strikes, okay? So does that make sense? So anybody who's on here right now, I can't spell butterfly while I'm doing this live because I'm thinking about too many different things. Anybody who's on here right now, if you have any questions, let me know. I'll jump in the comments here for a second and get to those. Cruz said, what is a good rule of thumb to determine whether it's worth it to roll up the untested side? If we can only get an extra 15 cents, is it worth it to do it? I think it depends on the overall credit that you have, right? But you got to make that decision if it's worth it. Sometimes I will not roll and adjust for like 10 cents or 15 cents. It's got to be, a significant reduction in the payoff, right? The reason that we do it, I would say like if it's a lower width spread, so like if it's 3 to 5 strikes wide, maybe you could do something for like 40, cents at the minimum. If it's, $5 to $10 wide, I mean, you really want to take in like 80 cents to $1 in premium, if that kind of helps give you maybe some like general guidelines. But if you're getting close to expiration, I mean, every penny counts, right? If you can cut a loss from $300 because you're trading a couple contracts and cut that loss down to, $210, I mean, that's a huge reduction in just a loss that you were going to take anyway, right? Like that's what we're trying to do here. So especially with these iron condor adjustments, the whole idea in doing this whole process is first, number one, is to reduce risk. And I think that a lot of people get this really confused because they think adjustments are meant to be there to, to kind of like pad your credit. And credit is just a way to reduce risk. So you want to reduce risk if the market continues to move the direction that you don't want it to go, which is considerably higher, considerably lower. The second goal of doing this, obviously, is to increase the credit and potential profit if it moves back, right? So you want to increase your credit and your potential profit if the stock moves back lower, right? But a lot of people get this all mixed up and they do number two over number one. They try to increase their credit because they want to make more money if the stock moves back, but they don't really think about reducing risk. That's what I think about. I think about taking a $300 loser and cutting it down to a $210. And if I can do that 50 or 80 times a year, like that's a lot of money back in my pocket, right? On a trade that just would have gone completely against me anyway, right? There's nothing you can do about it. You can't really kind of force the situation in the market. Okay, so does that help out? Does this help out for those of you who've been watching live here? So I appreciate you guys jumping in here middle of the day. I know it's like my kids are sleeping right now, so I always got to get these in middle of the day. So let me know via hearts and likes if you guys enjoyed this. So any questions on adjustments? So we'll just put here just for a second. Adjustment cues. Any questions on adjustments that I can help answer right now? You can either do one of two things. You can ask it live right now if you're watching this video afterwards. Go ahead and add it in the comment section right below. If you have even more questions afterwards, then click the link here. There's a couple videos that we'll put in here and link up to that are like longer videos and more examples with our trading platform that you can see right in the comment section or the kind of like status update section here on Facebook. So just click that link and let me know if you have any questions there. So I think that pretty much wraps it up. As always, if you guys need anything, let me know for sure. Really appreciate you guys jumping in. Again, if you guys enjoyed this, let me know by sharing it. Give me some hearts and likes. That always helps out and helps spread the word about what we're trying to do here at Option Alpha. And until next time, happy trading.